Now we'll be starting with the valuation. Basically, this is very important chapter from examination point of view. Fundamentally, one practical question is definitely asked from this chapter. So it is a valuation of goods for the purpose of charging the duty of customs. So it is basically valuation of goods. Valuation of goods for the purpose of charging duties of customs. Now here the value can be either transaction value under section 14(1) of the Customs Tariff Act 1975 of the Customs Act 1962, or it can be what? The tariff value. It can be the tariff value under section 14(2) of the Customs Act 1962. It's Customs Act 1962. Okay. Now here, let us start with the section 14. Basically, this section, provisions of section 14, they are applicable for valuation of imported goods as well as what? The valuation of export goods. For imported goods as well as export goods, the provisions of section 14, they are basically applicable. So the provisions of section 14 is applicable for valuation of imported goods as well as export goods. So fundamentally, what will be the value? The value will be the transaction value. Value is what? The transaction value. Whether it's in case of imported goods or export goods, the value is the transaction value. That is the price actually paid or payable for the goods. It is invoice value, that is the price actually paid or payable for the goods. Now in case of importation, when the goods have been sold for export to India, for delivery at the time and place of importation, the value is the value for delivery at the time and place of importation, where the buyer and the seller of the goods must not be related. Where say the importer and exporter, they must not be related, the buyer and seller of the goods are not related, and the price is the sole consideration for sale. So fundamentally, what is the value? The value is the transaction value, it is the invoice value, that is the price actually paid or payable for the goods when sold for export to India for delivery at the time and place of importation, where the buyer and seller, they must not be related, and the price is what? The sole consideration for sale. In case if the buyer and seller are related, or price is not the sole consideration for sale, or say value cannot be determined for any other reasons, then we have to go to the valuation rules for determination of value. In all the cases, the valuation will be done as per the provisions of the valuation rules. Now, in case of export also, provisions of section 14 are applicable. What the provisions of section 14 states is, the value of the export goods, it shall also be the transaction value. Value of export goods, it is the transaction value, that is the price actually paid or payable for the goods when sold for export from India. It is price actually paid or payable for the goods when sold for export from India for delivery at a time and place of exportation. For delivery at a time and place of exportation, where the buyer and the seller of the goods are not related. Where the buyer and the seller of goods are not related, and price is the sole consideration for sale. And here the price is the sole consideration for sale. Besides this, in each of the cases, the value will be determined as per the provisions of, the valuation rules. And here, as you are aware, for converting foreign currency into Indian currency, for converting foreign currency into Indian currency or vice versa, the exchange rate will be applicable. The exchange rate as notified by CBIC, will be taken on the date of presentation of bill of entry, as applicable on the date of presentation of bill of entry, or say shipping bill or bill of export. So exchange rate as notified by CBIC will be taken for, on the date of presentation of the bill of entry or shipping bill or bill of export. So here, if US dollar 1 lakh has been the FOB value of the goods, and it is to be converted into Indian rupees, which rate we have to take? CBIC rate. We have to take RBI rate? Well, no, we are not required to take the RBI rate. We have to take CBIC rate. Of which date? Of the date of what? Bill of entry. When bill of entry has been presented, when CBI rate is $1 is 80. That will be basically taken. So this was about the statutory provisions. They say that the value of these goods will always be determined in accordance with the rules. As per the provisions of section 14.2, as per the provisions of section 14.2, in respect of the notified commodities, CBIC has a power to fix tariff value. CBIC, they have a power to fix tariff value for any class of imported goods or export goods. For any class of imported goods or export goods, having regard to the trend of the value of such or like goods, having regard to the trend or the value of such or like goods, and where the tariff values have been fixed, then the duty will be chargeable with reference to such tariff value. In case the tariff value has been fixed, the duty will be chargeable with reference to the tariff value. Now, further you see that the valuation, whether in case of imported goods or whether in case of export goods, the valuation will be done in accordance with the rules. Value will be determined in accordance with the rules. Now, for this purpose, they have framed for both importation and exportation. They have made, for importation, they have made custom valuation, determination of value of imported goods rules 2007. Custom valuation, determination of value of imported goods rules 2007. And rule 2, that is dealing with the definitions. Rule 3 is determination of the method of valuation. Rule 3, the determination of method of valuation. Basically, the value will be what? The transaction value. And this transaction value is to be adjusted in accordance with costs and services of Rule 10. This is to be adjusted in accordance with costs and services of Rule 10. So that is what basically the most important rule is Rule 3, when the conditions of 3.2 are satisfied, and the same is adjusted in accordance with costs and services of Rule 10. And in case if the value cannot be determined as per the provisions of Rule 3, then the value will be determined proceeding sequentially from Rule 4 to Rule 9, that is the transaction value of the identical goods, transaction value of similar goods, then it is deductive value, then computed value, and then residual method. That is the best judgment method. That is the best judgment method. We will be discussing each and every one. This is a very, very important that we have to make the adjustment of the costs and services of Rule 10. So Rule 3 and Rule 10 are the most important ones. Then declaration is to be given by the importer that the value has been determined as per the provisions of the Act and the rules made thereunder. And in case if the proper officer is not satisfied with the value so declared, then he has a right to reject the declared value. And Rule 13 is dealing with what? The interpretative notes. Then we come to what? First of all, what Rule 3 states is, what will be the value? The value will be what? The transaction value. The value will be what? The transaction value adjusted in accordance with the costs and services of Rule 10. It will be adjusted in accordance with what? The costs and services of Rule 10. So fundamentally, what is transaction value? Transaction value is the price actually paid or payable for the goods when sold for export to India for delivery at a time and place of importation, where assessee and buyer are not related, and the price is what? The sale consideration for sale. So fundamentally, as per the provisions of Rule 3.2, the transaction value shall be accepted. These are the conditions which are to be satisfied. These are the conditions which have been provided in Rule 3.2 which are to be satisfied, that there are no restrictions as to the disposition or use of the goods by the buyer. There must not be any sort of restrictions as to the disposition or use of the goods by the buyer. Buyer, that is how the buyer will be using the goods. The seller will not be imposing any restrictions as to the disposition or use of the goods. However, certain restrictions can be imposed. Certain restrictions, the same can be imposed. Which type of restrictions can be imposed? Basically, which are imposed by law, restrictions imposed by law, geographical area in which the goods may be resold. Geographical area, basically allocation, or restrictions which do not affect value. Restriction which do not affect value. If these types of restrictions are there, they will be regarded as the valid restriction. So there must not be any restrictions as to the disposition or use of the goods by the buyer. Then sale or price is not subject to some condition or a consideration. Sale or price is not subject to some condition or a consideration for which value cannot be determined in respect of the goods being valued. Some conditions can be tie-up sales, full line forcing. These type of conditions must not be there. If you want to purchase goods X from us, then you will be required to purchase goods Y also. We will be giving you goods X only when you will be giving some material in relation to goods A. So these type of conditions must not be there. Then no part of proceeds of subsequent resale or say disposal or use of the goods by the buyer will accrue directly or indirectly to the seller. So no part of the proceeds will of say the subsequent resale or disposal or use of the goods by the buyer will accrue directly or indirectly to the seller. But in case if the same accrues, then either the same can be adjusted as per the provisions of Rule 10, otherwise the condition will not be fulfilled. Then the buyer and seller, they must not be related. The buyer and seller must not be related, and in case buyer and seller are related, then the transaction value basically is acceptable for customs purpose as per the provisions of 3.3. Now when the buyer and seller can be regarded as related, as we have seen in explanation to section 15 in GST, similar is here. Basically from this it has been taken there. Explanation to section 15 in GST, here it is rule 2.2. In customs it is rule 2.2. When the buyer and seller will be deemed to be related. If they are officers or directors of one another business, or say they are legally recognized partners in the business, they are employer and employee, any person directly or indirectly owns, controls or holds. Here it is 5%, there it's 25%. Here any person directly or indirectly owns, controls or holds 5% or more of say outstanding voting stock or shares of both of them. One of them directly or indirectly controls the other. Both of them are directly or indirectly controlled by a third person. Together they directly or indirectly control a third person, and last one is they are the members of the same family. And in case one is a sole distributor or sole agent or sole concessionary, he will not be regarded as related unless he falls under the relationship of the above criteria. So being a sole agent, sole distributor or sole concessionary, the same will not be regarded as related when unless and until he satisfies the above criteria. Now besides this, they say that where buyer and seller are related, the transaction value will be acceptable. Where buyer and seller are related, the transaction value will be acceptable. If the importer demonstrates, either one thing is there, where the examination of the circumstances reflects that. Where the examination of the circumstances reflects that what? That a relationship does not influence the price. First is where the examination of the circumstances reflects that the relationship does not affect the price. Number two, if they are of the opinion that relationship is influencing the price, then the importer demonstrates that what is the transaction value of say identical goods or similar goods. Transaction value of identical goods or similar goods basically in sales to unrelated buyers in India, in sale to unrelated buyers in India at that time. Then the deductive value of say the identical goods and the similar goods. It is the deductive value of say identical goods and the similar goods, or say computed value of the identical goods or similar goods. So importer demonstrates the same at or about the time of the importation. This is the identical goods or this is similar goods which have been imported by unrelated buyers. However, say substitute values shall not be established. However, here substitute values shall not be established. Now basically the value of the goods will be the transaction value, and it is adjusted in accordance with the provisions of what? Costs and services of Rule 10. It is adjusted in accordance with the provisions of costs and services of Rule 10. Now what is very very important is we have to adjust the transaction value in accordance with what? The costs and services of Rule 10. So basically the transaction value, in the transaction value, that is the price actually paid or payable, the following costs and services will be added. Basically the same will be added to the extent they are not includable in the price actually paid or payable. So these will be added. The transaction value, in the transaction value they shall be added to the price actually paid or payable for the imported goods if the same are already not included. This is 10.1. Now 10.1a is what? The costs that are incurred by the buyer, but they are not included in the price actually paid or payable. So in case say these costs are incurred by the buyer, but the same has not been included in the price actually paid or payable, the same will be added. What the costs are? Commissions and brokerages except say buying commission. So what you have to add in the value is, number one, if any commissions and brokerages are to be paid, they are paid separately, that will be added. But buying commission will not be added. What will not be added? Buying commission will not be added. What is buying commission? Buying commission is the fees paid to the agent who is representing the importer abroad. Fees paid to the agent which is representing the importer abroad. In case of any local agent commission is there, local agent commission, if they have specifically mentioned local agent commission, same will be included. Then we are having the cost of containers. The cost of containers which are being treated as one for the customs purpose with the goods in question. So the cost of containers will be added, and then the cost of packing, whether for labor or materials. Cost of packing, whether for labor or materials, the same will be added. So if packing charges have been paid separately for materials and labor, that will be added. Then if container goods are imported along with the containers, that will be added. So these are the three items under 10.1a which are to be added. Then 10.1b is what? 10.1b, basically it is dealing with what? If any say materials have been supplied by the importer, the same has been supplied by free of charge or a reduced cost for use in connection with production and export of the goods. So the importer has provided the materials to the exporter who is using the material in the imported goods. Then the value of the material so given will be added. That is value apportioned of the following goods and services. The same will be added, the value apportioned appropriate of the following goods and services. These have been provided by the importer. To exporter free of charge or at reduced cost. So fundamentally the value apportioned as appropriate. The value apportioned as appropriate of the following goods and services which are provided by the importer to the exporter free of charge at reduced cost. That is what? The materials, components, parts and similar items. Materials, components, parts and similar items incorporated in the imported goods. Materials, components, parts and similar items which have been incorporated in the imported goods, they have been provided. Tools, dies, molds and similar items which are used in production of the goods, and materials consumed including the in the production of the imported goods. And this case, engineering, development work, artwork, design work, plans and sketches, they are undertaken elsewhere than in India. They are undertaken where? Elsewhere than in India, and necessary for production of the imported goods. That is, they are undertaken elsewhere than in India and necessary for production of the imported goods. So 10.1b is dealing with this. So we have to determine the value. Say molds are provided free of cost. The value of mold is say rupees 10 lakhs, and out of which say 1 lakh units can be produced. So, and this 1 lakh units are imported. So in this particular case, the apportionment will be made of 10 lakh rupees in 1 lakh unit. Say out of, say only 10,000 units are to be imported and mold will be returned. Then life of the mold still remain 90,000, then also 10 per unit will be added. Okay, this is 10 per unit. Then in case the mold will remain with the exporter and only 10,000 units are imported, then 10 lakh rupees will be apportioned on 10,000 units only. So here, we have to determine the value of these, and which are provided by the importer free of charge or reduced cost, and then we have to apportion the same. Then 10(1)(c) is what? 10(1)(c). 10(1)(c) is royalties and license fees. Royalties and license fees related to the imported goods. Royalty and license fees related to the imported goods, and which is paid as condition of sale. That will be included, which is paid as condition of sale. The same will be included. Royalties and license fees, this is that is included in the value. And here, even if the goods are subjected to the process for which royalty is paid, after importation, the same is subjected to that process after importation, then also the royalty and license fees will be included. Then 10(1)(d), 10(1)(d) is what? 10(1)(d), that is dealing with what? The value or any part of proceeds of subsequent resale, disposal or use of the imported goods that will accrue directly or indirectly to the seller. Say seller has sold the goods to the buyer at price of rupees 100, and when buyer subsequently resells, rupees 10 is given to the seller. So the actual payment which has been made to the seller is 100 plus 10, 110. So in case quantification is there, as we have seen in 10(1)(d), if the quantification is possible, that will be added. And in case quantification is not possible, then in that particular circumstance, this rule 3 will not be applicable. We have to switch to rule 4. Then all other payments, 10(1)(e) is providing that all other payments made as a condition of sale, the same will be added. Besides this, whatever additions are made, additions will be made on the basis of objective and quantifiable data. Whatever additions are made, additions will be made on the basis of objective and quantifiable data, and no additions will be made except as provided in these rules. These 10(1)(a), 10(1)(b), 10(1)(c), 10(1)(d) and 10(1)(e). Other than that, additions will not be made. So basically, royalty and payment for process of importation, the same will be made even if the goods are subjected to the said process after importation. Then we come to what? 10(2). 10(2) is dealing with what? How you will be determining the value. Basically, here, first of all, free on board value is there. FOB value of goods is there. Then whatever costs and charges, as we have seen under 10(1), that will be included. So charges for costs and services as provided in rule 10(1), the same is included, excluding what? The charges for post-importation activities. What is excluded is charges for post-importation activities. Now this will give you what? The customs FOB value. In this we have to add, say, first one is cost of transport. We have to add what? Cost of transport. If it is actual will be added. That is actual cost of transport, loading, unloading and handling charges associated with the delivery of the imported goods to the place of importation. Now in case of air, if actual charges are ascertainable, it cannot exceed 20% of the customs FOB value. In case of air, when these charges are ascertainable, the same cannot exceed what? 20% of the customs FOB value. In case of if goods are imported by air and the charges exceeds 20% of customs FOB value, it will be restricted to say 20% of the customs FOB value. Say for example, if US dollar 1 lakh is the customs FOB value. Okay, it is customs FOB value. And they say air freight is US dollar 25,000. So air, it will be restricted to 20,000 US dollars only. It will be restricted to about 20,000 US dollars. Then in case if actual cost of transport, loading and unloading charges and handling charges associated with the delivery of imported goods or place of importation are not ascertainable, then it will be, but customs FOB value is ascertainable, then it will be 20% of the customs FOB value. Here, in case customs FOB value is also not ascertainable, if customs FOB value is not ascertainable, then in that particular circumstance, it will be what? 20% of the customs FOB value plus cost of insurance. It will be 20% of the customs FOB value plus cost of insurance. Then second, what is to be added is the actual cost of insurance. Actual cost of insurance is to be added, and if the same is not ascertainable, it will be 1.125% of the customs FOB value. It will be 1.125% of the customs FOB value, and in case if the customs FOB value is not ascertainable, if the customs FOB value is not ascertainable, then it will be what? 1.125% of the customs FOB value plus cost of transport, loading, unloading and handling charges. It is 1.125% of say customs FOB value plus cost of transport, loading, unloading and handling charges. So actual cost of insurance is added, but in case the same is not ascertainable, it is first 1.125% of what? The customs FOB value. So for example, in this case they say cost of insurance is not ascertainable, then we have to take what? US dollar 1 lakh into 1.125%, that is 1125. Likewise, and this is giving you what? The CIF value. What is CIF value? Customs FOB value plus cost of transport plus cost of insurance. This is basically the assessable value on which you are required to calculate the import duty. So this is very important. This is the most important rule. 10 is the most important rule from examination point of view. These two are the very important ones. This is very important. So remember, you have to read, you have to do this thoroughly. This rule is the most important rule. Then we come to what? If you cannot determine the value as per rule 3, then the value will be determined proceeding sequentially from rules 4 to rule 9. Sequentially you have to proceed from rule 4 to rule 9. First of all, rule 4 is, what rule 4 is? Rule 4 is transaction value of identical goods. Rule 4 is transaction value of identical goods. Now basically say this one bottle is there and this is imported, this is also one bottle is there. So these bottles are identical. Basically they are same in all respects. They are same in all respects having regard to physical characteristics, quality and reputation. There can be minor differences in the appearances. It can be possible that there are minor differences in the appearances, but that do not affect the value of the goods. So they remain identical. Say if this is made in Germany, then this is also regarded as made in Germany. This will be also made in Germany. That is produced in the country in which the goods being valued were produced, and produced by the same person who produced the goods, and it is produced by the same person who produced the goods, but where such goods are not available, then they can be produced by a different person also. So this is basically identical. So what identical goods means? What? Identical goods means imported goods which are same in all respects, having regard to say physical characteristics, quality and reputation of the goods being valued, except for what? The minor differences in the appearances, except for say minor differences in the appearances that do not affect the value of the goods. Then what is not included in the same, but it shall not include imported goods, say where engineering, development work, artwork, design work, plans and sketches, they are undertaken in India, they were completed directly or indirectly by the buyer free of charge or at reduced cost for use in connection with production and sale for export of the imported goods. That is not included. It shall not include what? The imported goods, say where the engineering work, development work, art work, design work, plans and sketches, they have been undertaken by the buyer. In India the work has been done, then the goods have been sent out of India, and on the basis of that engineering, development, artwork and design work, the goods are imported, manufactured and imported. That won't be regarded as identical. Now similar is basically commercial substitutes. Similar is commercial substitutes. Now they say, what is similar goods? Similar goods means imported goods. Similar goods means imported goods which although not alike in all respects, Similar goods are not alike in all respects. They have, say, like characteristics. They have like characteristics and like component material. They have like characteristics and like component material to enable them to perform the same functions. They have like characteristics and like, say, component material to enable them to perform the same functions, to be commercially interchangeable with the goods being valued, having regard to, say, quality, reputation and existence of trademark. Then this part remains same. Produced in the country in which the goods being valued were produced by the same person who produced the goods, and in case that goods are not available, then goods produced by a different person. But what is not included here? Engineering work, development work, art work, design work, plans and sketches which have been undertaken by the buyer free of charge or reduced cost for use in connection with production and sale for export of the imported goods. The same will not be covered under the ambit of, say, similar goods. Now, rule 4 is basically transaction value of identical goods. Rule 4 is the transaction value of identical goods, and rule 5 is transaction value of similar goods. So, basically the value will be taken as the transaction value of identical goods and imported at or about the same time, or say similar goods imported at or about the same time as the goods being valued. And here the identical goods shall be taken at the same commercial level and same quantity level, and in case if there are differences in the commercial level and quantity level, then adjustments will be made of the differences, and in case beside this, adjustments will also be made of the costs and services of 10(2), that is transport, insurance, charges. And in case on account of such adjustments more than one transaction value is determined, in case more than one transaction value is determined, then what you will take? Lowest value is taken. So basically, when at the time when the declaration for value is presented, if the value of the goods cannot be determined as per the provisions of rule 3, then we have to see the identical goods. What is the transaction value of the identical goods imported at or about the same time when the declaration for value is presented? Okay, that value is to be taken. Then rule 5 is similar. Instead of term identical, you have to substitute the term similar. Then rule 6 states what? Rule 6 states that the value is to be determined as per rule 7, and if the value cannot be determined as per 7, then value is to be determined as per rule 8. That is, first is deductive value, and then it is a computed value. However, at the request of importer, the order of application of rule 7 and 8 can be reversed. That is, first 8 is applied and then rule 7 is applied. That is, first 8 is applied and then rule 7 is applied. So rule 7 basically is what? Deductive value. What is rule 7? It is deductive value. As the name suggests, we have to make deductions. So the unit price at which the imported goods or identical goods or similar imported goods, unit price at which the imported goods or say identical goods or similar imported goods, they are sold in greatest aggregate quantity at the time when the declaration for value is presented, but say not later than 90 days. Not later than 90 days. What is the unit price at which the greatest aggregate quantity of goods are sold to unrelated buyers? That is the thing. From that unit price, you are required to make deductions. That is what? Commission or selling expenses, general expenses and selling profits made in connection with sale of imported goods that is goods of same class or kind. So these general expenses include direct and indirect costs of marketing the goods in question. So commissions or selling expenses, general expenses and selling profits which are made in connection with sale of imported goods of the same class or kind. Transport and insurance costs. Transport and insurance costs which are associated, transport and insurance and other associated costs within India. Custom duties, sales tax and other taxes which are levied in India. Custom duty, whatever post importation charges are there, the same are to be deducted. And then if the goods are sold after further processing, then due allowance shall also be made to the value addition after such processing. So basically, the unit price at which the greatest aggregate quantity of goods are sold. From the unit price, what you have to reduce is the commissions or selling expenses, general expenses and selling profits. Whatever these are, they have been made. Transport and insurance and associated costs which have been incurred within India. Custom duties, sales tax and other taxes levied in India. And in case the value is based on say unit price after further processing, the processing cost is say deductible. This will give you what? The deductive value. This will give you the deductive value. Okay. Then computed value. What is computed value? As the name suggests. As the name suggests, it is giving you the costing. So if it is what? The cost of material and fabrication. Cost of material and fabrication and other processing employed in the imported goods. Cost of material and fabrication and other processing which has been say employed on the imported goods, profit and general expenses and costs and charges referred in rule 10.2 that will be added. This will give you what? The computed value. Now last one is the residual method, or it is say we can say best judgment method. So here, if the value cannot be determined, as per the above rules, then the residual method says the value will be determined using reasonable means. The value will be determined using reasonable means consistent with the principles and general provisions of these rules. The value will be determined using reasonable means consistent with the principles and general provisions of these rules and section 14 and the data available in India. However, the following cannot be the basis. Of determining the value. What cannot be the basis? That is the selling price in India of the goods produced in India. That cannot be the basis. Then a system which provides say highest of the two alternative values. Price of the goods in the domestic market of the country of exportation. What, say if goods are imported from London, what is the price in London? That cannot be taken as a basis. The price of the goods at which the goods are sold for export to country other than India, that will not be the basis. Cost of production other than say computed value of identical goods or similar goods. So we can take the computed value of identical goods or similar goods. Here minimum custom values or arbitrary or fictitious values cannot be taken. So basically relaxation will be there. Say in definition of identical goods, we have seen that country must remain same. So now actually the manufacturer from whom we are importing is having two units, one in Italy and one in Germany. We are importing from Germany and same goods are also imported from Italy. So here this criteria can be relaxed. Or in deductive value we have seen that the unit price at which the greatest aggregate quantity of goods after importation within a period of 90 days they are sold. So here the 90 days criteria can be relaxed. 90 days criteria can be relaxed. So this way this residual method works out the same. Then rule 10 is what we have already discussed about the costs and services. We have already discussed about the costs and services. Rule 11 is what? The declaration by the importer. This is theoretical one. That is the importer or his agent. They shall furnish a declaration disclosing full and accurate details relating to the value of the imported goods. And the custom officer has a power to satisfy about the truth or accuracy of the value so declared and the information so presented, and if subsequently found that the valuation is not proper or the information is not correct, then in that particular circumstance, the goods are liable for confiscation and other penal action can be there. Then the proper officer, in case Rule 12 states that in case the proper officer has a reason to doubt the truth or accuracy of the value so declared, then he has a right to reject the declared value. In case the proper officer has reason to doubt the truth or accuracy of the value declared in relation to the imported goods, then he has a right to say reject the declared value. Now you have to remember what can be the reasons. What can be the reasons for doubting the truth or accuracy of the value so declared? What can be the reasons? Basically, these can be what? The reasons. One is what? Say at the same time when the declaration for value is presented, significantly higher value at which the identical or say similar goods are imported at or about the same time when the declaration for value is presented in comparable commercial transactions were assessed. Or say the sale involves say abnormal discount or abnormal reduction from the ordinary competitive prices. Special discounts have been provided which is limited to the exclusive agents. Misdeclaration of goods in parameters such as description, quality, quantity, country of origin, year of manufacture or production. Non-declaration of parameters such as brand, grade, specifications that have relevance to value, and fraudulent or manipulated documents. So basically these are what these are the reasons for doubting the truth or accuracy of value, and in case if we clear their doubts, then our value will be accepted, otherwise they have a right to reject the declared value. So this was about the importation rules. Now for export also they have made what? The custom valuation, determination of value of export goods rules 2007. So basically rule 2 is definitions here, rule 3 is determination of method of valuation. So the value basically will be the transaction value. Then in case if the value cannot be determined as per rule 3, then it will be comparative value, that is determination of value by comparison, then computed value, and then is the residual method. Declaration and rejection aspects more or less remain same. So here in case of export goods, the value of the export goods shall be the transaction value. The value of the export goods shall be the transaction value. However, such transaction value is subject to the provisions of Rule 8. That is what? The proper officer has a right to reject the such transaction value. So basically, the value of the export goods shall be the transaction value of goods of like kind and quality. And the same is whatever goods they are exported, basically the goods are exported at or for whatever price, that is FOB value of export, that is the transaction value. And in case if this transaction value shall be accepted even when the buyer and seller are related, that is exporter of India and importer related, then also the transaction value is acceptable provided the relationship does not influence the price. And in case if the value cannot be determined as per rule 3, if the value cannot be determined as per rule 3, then the value will be determined proceeding sequentially from rules 4 to rule 6. Now rule 4 is determination of value by comparison. Rule 4 is determination of value by comparison. So the value of goods shall be based on transaction value of goods of like kind and quality. It is basically the value will be based on say goods of like kind and quality. That is what the identical goods or say similar goods which are exported at or about the same time. When the declaration for value is presented, and in case there can be say differences in the dates of transportation, or differences in say commercial level, quantity level, differences in say composition, quality, design, etc. between the goods to be assessed and goods to which they are compared, and differences in domestic freight and insurance charges depending upon the place of exportation. So adjustments will be required of the differences in the dates of exportation, differences in commercial level and quantity level, differences in composition, quality, design between the goods to be assessed and the goods with which they are compared, and differences in domestic freight and insurance charges depending upon the place of exportation. So this is basically determination of value by comparison. Then rule 5 is computed value. Rule 5 is computed value. So here, as you are aware, this is a cost of production that is to be taken. That is cost of production, manufacture and processing of export goods, charges for design or brand, and amount for the profit that will be added to determine the value. So basically this is the valuation mechanism, and here if FOB value of goods is 25 lakhs, export goods is 25 lakhs, then export duty will be levied this FOB value cannot be termed as cum duty price. Therefore, FOB value will be, that is export duty will be levied at rate of 10% of rupees 25 lakhs. That is 2,50,000 rupees. That's 2,50,000 rupees. This way, our calculation is made. So this was all about our valuation. This chapter is very, very important, and one practical question is definitely asked from this particular chapter.